I'm Tony Amaradio of Faithful with Finances, and I'm going to do a series of videos regarding the area of charitable plan giving. Charitable plan giving can be an important tool to enjoy personal satisfaction of giving during your lifetime and simultaneously have the benefit of legacy beyond your lifetime. It also is one of the most attractive sections of the Internal Revenue Code from a tax benefit standpoint. And we're going to talk today about a certain type of trust called a Charitable Remainder Unity Trust, which is a type of trust for a person who would like to sell a highly appreciated asset and completely eliminate the capital gains. And so the person forms a Charitable Remainder Unity Trust before they sell the asset. They transfer the title of the asset into their CRUT, then they sell the asset after that, and they completely eliminate all capital gains exposure. In addition, they get a significant tax deduction in the front end, and they also eliminate any potential estate taxes. So it's like a triple tax win: deduction in the front end, offset completely of any capital gains taxes, and elimination of the estate tax. There's two types of Charitable Remainder Unity Trust. One is called a CRAT, and one is called a Charitable Remainder Unity Trust. The AT form basically provides a fixed income for the person during the period of time or their lifetime, while the CRUT provides a percentage of the assets at the end of each year. Each can be an excellent option to provide income stream for the person that transfers the asset in the charitable trust and needs significant tax benefits. Stay tuned for more charitable trust series.